Well, my friend, I have the answer. Bible Way Hibner Memorial Church of God in Christ presents Chain Breakers, this and every Sunday at 9 a.m. here on WHYL.
From the L.B. Smith Ford Lincoln Studios, Oldies 102.9 is WHYL Carlisle.
Welcome to the Real Estate Radio Guys, your weekly source for all things real estate. We're your hosts, real estate broker John Rainville and your mortgage expert Kingsley Harmer, discuss everything from mortgage rates to home staging for foreclosures and everything in between that affect the daily real estate market. Real people, real questions, real answers. Today's show is brought to you by www.pagoloan.com, your source for new mortgage loans. NMLS number 1018. EnviroQuest, trusted for home inspections and radon mitigation in Central PA for over 25 years. And brokersrealty.com, the easiest way to search for real estate in your hometown. Now, on to the show.
Good morning. It's a frosty morning here in Pennsylvania, getting ready for the Super Bowl tomorrow. You're listening.
Go Eagles!
Listening to the Real Estate Radio Guys here on WHYL 102.9 FM. And good morning, Kingsley. How are you doing, buddy?
Good morning. How you doing?
Good. So we're trying some new technology out, folks. So, I mean, our Facebook feed may be off today because we're trying some new studio software out with our cameras. But we're working on that. Today's show, I think it's going to be a very interesting show for folks because we're going to be talking about really what's involved on the loan side, what's involved with getting a mortgage and trying to really explain it. There was just an article out about a week ago saying that like 92% of Americans really don't understand what's going on in the financing and how it all works. So Kingsley and I have got a really detailed show. It's going to be pretty quick, fast moving today. We're going to have John Staz on, from EnviroQuest. He's going to be explaining about what to look for on your home inspection report, because that's also very important. We want to talk about financing here this morning. And so we're going to go through, and Kingsley, he's an expert here from GSF Mortgage, and he's going to be talking to you and explaining what things work and how they work. So how much house, can you afford? That we're going to start off. We're going to go through definite sections. And if you have any kids that are thinking about buying a home, or if you're thinking about refinancing or moving up, things have changed a little bit, so you definitely want to listen in. So, Kingsley, tell our listeners, how do they figure out how much house they can afford?
Well, the simplest answer for any of this is to really talk to a licensed professional. They have the knowledge, they have the training to walk you through all the steps and, of course, guide you as far as what you should and what you should not buy. The other thing is they can pretty much tell you what you can and can't afford as far as what a maximum is, and that's usually determined by a combination of things that include your total income versus the total amount of debt that you have, which is car payments, credit cards, student loans. It even takes into account anything like child support or alimony, that sort of thing. And it all gets combined into what is lumped in as a total DTI, or debt-to-income ratio. And each of the different programs that are out there have different thresholds for that debt-to-income ratio.
A lot of people want to know that there's so many different loan types out there, Kingsley. How do they figure out what one works best for their family's finances?
Well, I don't think it's necessarily a matter of what they figure out. I mean, the loan officer is going to check your individual stats and your whole loan application and figure out which programs that you qualify for. And there's a lot of different programs from FHA to VA to USDA. And in a lot of cases, we have different bond programs that help with down payment assistance programs. Your credit's going to affect which of those programs that you can qualify for, and each program has their pluses and minuses. So a good loan officer really is going to give you those options and really allow you to pick what you feel is the best one for you. Well,
that makes sense. I know that there's things that people can do that will increase the chances of getting approved for a mortgage. What are some of those?
Well, the first thing when you're looking to buy a house is you want to make sure you have income or a stable job, stable income. You can consider Social Security technically a stable income, retirement a stable income, but more often than not, you're going to have an actual job that you want to have for a specific amount of time. Typically, a lender's going to look at your last 2 years of employment. And one of the factors that goes into your approval, of course, is that you didn't jump around to 10 different jobs over the course of that period.
What are some of the things that they should do? I mean, should they pay down their credit accounts? What are some of these things that they need to do?
Well, the long and skinny of it is, if you're looking a year or two out, obviously it comes down to your comfort level as far as what you can and can't afford. So it's going to come down to budgeting. For example, if you're paying $1,000 a month rent, you've got 2 car payments for $1,000 and 3 credit cards and student loans, and you're really tight for your own comfort level. The last thing you want to do is get a mortgage where your mortgage payment is either at the same or above. So you want to start thinking of ways to maybe minimize your monthly debt. So yeah, paying down debt is a good idea in that circumstance. Paying down debt is also a great tool for helping your credit scores go up gradually over time, as that's one of the biggest factors. So you definitely want to pay down those accounts if you're looking into the future. Another thing you want to do is really start with that budget to start saying, okay, look, I know I'm going to need some money for a down payment and or closing costs. So let's come up with a savings plan. Let's start to accumulate some assets. You've hopefully got your 401k and IRA set up, which is a great factor as far as what they call reserves. But start putting a certain monthly amount aside and also know what your target amount is that you're going to need for purchasing a home. So once we get to that point as far as paying down credit accounts, managing your debts, and coming up with your monthly budget, you want to start to kind of figure out where you're at on the credit spectrum. And by paying down a lot of those debts ahead of time, a lot of times that's going to help your credit scores go up. But there may also be things on your credit report that you're unaware of. So at this point in time, if you haven't spoken to a licensed loan officer to help you through this process, you can always get a free credit report from each of the bureaus, which I highly recommend doing. They may not give you the scores, but at least you'll know whether or not there's something on there that shouldn't be. It could be an old collection, could be something that just popped up from an old rental apartment where you had a credit with a satellite dish that you thought was paid, but all of a sudden you've got a $70 charge off. Even though it's only $70, that can affect your credit score, quite immensely. So those are some of the things that you can do when trying to prepare to get into a mortgage.
So really, what should any of our listeners look for in a lender?
Well, bottom line is you want somebody that's knowledgeable. At the end of the day, for a first-time home buyer, you need somebody that's going to help guide you through all of these different mazes. For example, when you get a credit report with me and a pre-qualification, I know exactly where you're at. We look at your picture, your financial picture, and come up with a pathway as far, the easiest way to home ownership that there is. So we'll give you step-by-step tasks to perform if you're not quite ready yet. And also we're going to give you a couple of steps to maybe improve the type of program that you can get into. A lot of times your credit score could be just low enough to not qualify for the down payment assistance, and with a few tweaks we can get you there. So at the end of the day, find somebody that's knowledgeable, that's been around the block, once or twice, and knows where to direct you in order to get your home.
Well, I know with the new the Trump tax plan that's in and we're starting, with the stock market the way it's had a little bit of volatility lately, we're seeing the interest rates coming up. which we all knew was going to happen sooner or later. But I know a lot of our listeners would like to know, I mean, should they choose a fixed rate mortgage or should they go with an adjustable rate?
The simple answer to that is always go with a fixed rate mortgage if you are, first of all, a first-time home buyer, and this is new to you. It's the most stable way to purchase a home. Your payments won't fluctuate. It was at one point that an ARM, adjustable rate mortgage, was utilized by a lot of professionals, people that were investors, or in a lot of cases, an adjustable rate mortgage is fixed for a specific period of time, usually 3, 5, or 7 years. And if you're in a job or military perhaps where you know you're going to move in 4 or 5 years, you can often get a little bit lower of a rate by going with an adjustable rate mortgage, but it's still going to be fixed for that particular period of time. But keep in mind, you have to have an exit plan for that house. You're going to either have to sell it, refinance it, or rent it, and then after that period, those rates can adjust, which will affect your payment each month.
I mean, but you can sort of guide them through that, because I know that, you know, back in the day when we had higher interest rates, sometimes you took like an adjustable rate and it was fixed for maybe like 3, 5, 7 years, and then there was something where there was like a break-even point, right? There was a point where after it, you know, it didn't make sense, and that you would advise them on.
Well, again, I mean, yes. There are very few people that an adjustable rate mortgage, in my opinion, would be beneficial for. For those that think that it may, you know, because of the lower rate, that's certainly something that we can walk the client through. But at the end of the day, we want to make sure they're not going to be put in a precarious position in 5 or 7 years to say, hey, my mortgage payment just went up $300. I can't afford that. So if you can't afford the adjusted rate in 5 years, you know, I'm going to be very hesitant on saying that's the route you should go.
So are there different, you know, loan type products or loans offered for different loan amounts based on the, you know, the price?
Well, there's different segments to the market. You've got conforming loan amounts. You've got jumbo loan amounts. You know, most of the guidelines are going to, I think we're up to $421,000 is considered a normal conforming loan. Anything over that is considered jumbo, where you have different programs that you're going to have to qualify for. But most of them are going to fall along the lines of your conventional loan amounts.
And what defines a jumbo loan? What really what is that different by state, different by area, or is it just like this is what it is wherever you buy here in the States?
Well, for the most part, depending on the product of the lender, a jumbo loan is really just going to be based on the loan amount itself. And when you jump into jumbo loan categories, you know, most of the time you're going to have a sizable down payment. You're not going to have those first-time home buyer 0% or, you know, low 3.5% entry-level type down payments into the market. At this point, it's supposed to be your bump-up home, maybe your final home that you're going to be purchasing. So you've already probably owned a home at this point and have a little bit of experience. And also you probably might be rolling some equity in from a previous home as well.
Interesting. So, I mean, are the rates much different on those jumbo loans?
They can go up, yes.
Okay, because it's, I guess, maybe a little bit riskier loan for the bank.
It is a riskier loan.
So how does the bank or the mortgage company determine a mortgage rate? Is it just something they pick out of the air, or how does that come about?
You know, for years I kind of thought that.
Did they just pick the rate from the sky?
Well, you know, when I first started as a loan officer, you know, you'd wait in the morning, you know, back in the day before the internet and everything else automated this stuff. But there's always a financial guy that sits at a desk every day and would print out rate sheets. And I thought, well, why are the rates like this today? That's not cool. I have somebody ready to buy. You can't just raise rates like that. And, you know, one day I decided to walk in and kind of confront the guy. And he was very nice at the time and sat me down and said, look, these are all of the factors that go into interest rates. Of course, the bank has to be profitable, which gets priced into every market, which is why a lot of times you have different pricing from bank to bank. But the markets themselves, bond markets, 30-year market, 10-year T-bill, and then everything else in between kind of indirectly affects these different levels. So it's all based on risk and what the bank is able to buy their money at.
So one of the big indicators I've heard over the years from different people is the bond market. So interest rates go the opposite way of a bond market, or
interest rate? Well, yeah. I mean, if you're talking about a 10-year T-bill, it's an inverse effect on that. So it's not. You can't just say because the T-bills are going down that the interest rates are going to go up, or vice versa. There's a lot of different factors that go into it, but it is definitely a good indicator. And at the end of the day, it really, again, is how much can a bank acquire its money for? A bank is borrowing money, really, in essence. So you're getting this money from investors and other sources, and if they're getting their investments for, say, 3.5%, when they're able to offer that money to you through lines of credit, it's certainly not going to be less than 3.5%. They have to factor in different, profit, loan officers, underwriting staff, processing staff, licensing. There's a lot that goes into running a mortgage company, unfortunately. So there is an addition to whatever that money is that they bought.
So I know on many of our shows, I know the other week we were talking about the construction financing in that, and we've talked in the past about VA mortgages and USDA. But one of the things that I know you get asked by a lot of the people when they're coming to get pre-qualified or pre-approved for a loan is that they want to know how much money should they put down, when they go to buy this house.
Well, just like your budget, unless it's a matter of, hey, look, this is how much I have, can we make it work? There's a lot of different scenarios where people will say, well, I would rather put 50% down versus 20%. And, it's going to come down to everybody's individual circumstances. Say, for example, you have a borrower that's on a fixed income, and every month they're only going to get a certain amount, but they have a sizable amount of cash in the bank, either through a retirement account or an investment that they had, and they'd like to buy a house, but they want it to fit.
Yeah, I know.
They want it to fit within their budget. Well, in that particular case, if you've got the money, we're going to find out what that amount is to make your monthly payment to fit within your comfort zone. Now, from program to program, we've got these great new programs where there's literally zero down, right? You've got USDA, which is zero down, VA, which is zero down, and now we've got bond assistance programs that also help with an FHA loan to basically cover the 3.5% that you can put down. For those of you that are, financially responsible and that have good credit scores, of course, we can always help walk you through and tweak you to get you there. But it's not always the best case scenario to not put anything down, because you might end up with a better program or better rate by putting 5% down or 10% down. So it all really comes down to each individual circumstance.
But a good loan officer will obviously weigh out all their different options and then help them guide them on what looks like their best way to do it, right?
Again, I mean, really the best way is to find an educated loan officer that understands the market, understands all of the different programs, and the pluses and minuses to each of them for your individual,
for your family's goals, right?
Well, yeah.
I mean, because people in different stages in their life will have different goals.
Absolutely. So it really does come down to, look, get pre-qualified. Everybody wants to get out and start looking at homes and start trying to figure out what they think their payments could be or what they could afford. Find a good loan officer to guide you through this whole process. At the very beginning, if you know exactly where you stand, then you know exactly what you have to do or what you can afford. The last thing you want to do is buy a home for $450,000, and in the back of your mind, you can pull it off, but you're going to be so tight per month. You're about to have another child. You may or may not be transferred in your job. All of these things can affect whether or not you should be stretching yourself for this house. So really find a good loan officer, get pre-qualified up front, know what your credit situation is and what you need to do to get where you really should be or are comfortable being as a homeowner.
So, Kingsley, the person comes to you, they bring their financial information, and we're going to go over that, I know, later on here. But what are the financial numbers, so to speak, that somebody like you or the bank looks at before, approving someone's mortgage?
Well, there's a lot of numbers that you're going to look at. So, the first thing is, obviously, we've already discussed, that's credit score. The second, which, the credit score obviously is an indication of your ability to pay. The second is going to be your income and your debt-to-income ratio, which we have brought up before, and that really is a broader picture of all of your debt, what type of home or size house you're looking to buy, and your ability to pay that. At the end of the day, that's really what it's about. Our job is to make sure that you can pay that. As everybody remembers back in 2007 when everything crashed, one of the overhauls, if you will, was taking away a lot of the stated income loans and adjustable rates or ARMs that you weren't able to afford that if, for example, that rate adjusted and your debt-to-income ratio was at 60%. I mean, believe it or not, 60% was done all day long as far as approving mortgages back in the day, which didn't make sense to me. 60% was before taxes taken out. So your mortgage payment could have been almost all of your income per month, not taking into account gas, food, groceries, and everything else.
A lot of times, from the realtor side, I get it where the people don't sometimes understand. They think that they have a lot of assets, and just because they've got a lot of assets, but they don't have any cash flow, that they're not really probably going to get a mortgage, right? They've got to have cash flow. They got to have numbers, money coming in, cash.
Yes. Again, my job is to, as a licensed loan officer, is to make sure that we are putting you into a position to be able to afford your home. And at the end of the day, the last thing I want to do, because I have to be able to sleep at night, is to get you into that home that you think you want for $400,000 or $500,000, and every single month you're sitting there with the stress, on your shoulders, figuring out how am I going to pay for this, or if a car breaks down, do I pay to fix my car or do I pay for the mortgage? That's the last thing that we want, the position we want to put you in. So, yes, the numbers are important. We need to make sure that you can afford it. Now, as far as the assets are concerned, again, everybody's different, but you could have $1 million in the bank and you're buying a $200,000 house. Well, you're going to have the ability to cash flow because you hopefully have that invested. If you're the type of person that might be self-employed, there's a lot of programs that are out there for self-employed people where they're not able to show cash flow but are getting cash flow. And those assets can assist you in being approved for a mortgage because they have programs that will take that and average it out over 7 or 10 years and consider that income if you had a draw on it.
So what's the best number for you today before we go to break? We're going to come back and talk more about this.
Best number to get pre-qualified or call me, 717-200-4800.
The Real Estate Radio Guys with John Rainville and Kingsley Harmer. We'll be right back. Veterans, active duty military, and reservists. brokersrealty.com thanks you for your service. And during February, if you list or buy a home with brokersrealty.com, we will reward you with a getaway for 2 at settlement. As in a cruise, trip to Vegas, or even a whole week at a tropical resort-type getaway. Text REWARD to 79564. That's REWARD to 79564. Or Google brokersrealty.com today.
Are you working with a mortgage company that offers pre-approvals or just pre-qualifications? Does your mortgage company reward police, firefighters, military, teachers, and nurses with better rates and fees? How would you like to apply and be updated on the status of your loan right from your phone? Introducing GSF Mortgage Corporation, where technology and relationships make the difference. Visit pagoloan.com to apply or call 717-200-4800 for more information. NMLS number 1018.
Buying or selling a home? For professional home inspection, call EnviroQuest of Harrisburg. Their certified home inspectors will conduct a thorough inspection and provide a detailed report with many pictures. They'll explain the findings. Do you have elevated radon levels in your house? Call EnviroQuest. They have fixed over 10,000 homes over the last 25 years. For a professional home inspection or radon mitigation, call EnviroQuest at 233-6144, 233-6144, or visit EnviroQuest online at evqharrisburg.com. That's evqharrisburg.com.
Back to the show, the Real Estate Radio Guys with John Rainville and Kingsley Harmer.
Well, folks, I know our Facebook feed's off right now, but we will be posting this out, our video of this up hopefully later on today. We're trying out some new studio software, and sometimes it's above our pay grade. You know,
way above our pay grade.
I had Mr. Storm last night teaching me how to do some of it. Obviously, I got like 80% of it. So, you know, maybe he has to come in here and do it for us. But anyways, I'm back. It's John Rainville from brokersrealty.com, and I'm back with Kingsley Harmer from GSF Mortgage, and we're talking about all the ins and outs, how you become a ninja in mortgages. And I know that a lot of people don't seem to understand that there's a difference when they go to closing with interest rate and APR. Can you sort of give our listeners a little bit of a guideline on that?
Yes. It's crazy, in my opinion, APR, because it's more confusing to a first-time home buyer than it is helpful.
And what does APR stand for?
Annual percentage yield. So
wait a minute. Annual percentage yield, that would be APY.
APR, right? Rate.
Okay.
Rate, yield.
I just want to make sure that we're all talking the same thing that nobody understands.
So we all know what your interest rate is, right? Your interest rate is what determines what your payment is. The interest on your loan, and then you amortize over, 10, 15, 20, 25, 30 years, which determines what your mortgage payment is with principal and interest. So APR is this great invention that somebody came up with that it made you take certain expenses in the process of purchasing a home and lump them into this equation that is supposed to tell you that, well, because you had to pay a processing fee and because you had to pay an underwriting fee and because you had to pay a credit report fee and perhaps a flood cert fee, certain fees go into this equation that spit out an APR, which in essence really is the cost of money. So when you see APR, it's 99.9% of the time always going to be higher than what your interest rate is. Don't be alarmed. It's just what they consider the total cost of you borrowing that money.
So I call it voodoo math because it never makes sense to anybody.
And more often when you try to explain it, they're like, well, okay, well, just interest rate. But keep in mind this as well. If you are shopping through different mortgages, a simple trick is to look at the difference between your interest rate and your APR. And if you're comparing two mortgage companies that are giving you the same interest rate on a program and the same exact program, but one of their APRs is, 1% higher, that's kind of a quick sign to say, okay, there's obviously more costs involved with this loan than with Company A.
So when you meet with a family or a single person, how do you sort of explain to them, how do they choose between getting a low rate or getting low points? Because, there's a difference there. I mean, and a lot of times, I guess probably from a realtor standpoint, it would depend on how much money they have, right? How much cash they have.
Well, you may have the cash, you may not. Perhaps it's a scenario where you're getting, seller help towards closing costs, and you've got a little bit of extra assistance to where it might benefit. First, let's explain what a point is. A point is equal to 1% of the actual loan amount. So to use simple numbers, let's use $100,000. 1 point would be equal to $1,000. And really what that point is prepaid interest, okay? So you're prepaying part of the interest to get the interest rate down. When does it benefit the buyer? A lot of it is going to be obviously dependent on their circumstances, but it really comes down to time. So what you're going to do is compare the payment with the lower interest rate by paying points and the higher interest rate by not paying points, and then you come up with that difference in your payment, right?
Yeah.
So let's just take, for example, I have one written down here, 4% and 4.25% on a loan might be the difference of $36, right?
Right.
So if $36 was the difference in your payment, it's going to take, and you paid, let's just say $360 to get the difference in that interest rate. It's going to take you 10 months to break even, right? Okay. That would make a lot of sense. But in a lot of cases, 1 percentage point may only buy you down 0.1% of the interest rate, and that 1 point may cost you $2,000. Now it's going to take you 7 years to break even for that money that you spent up front.
So it sounds to me like what you're saying or advising our listeners is that the longer you're going to stay, the lower you'd want the rate. If you're on the short term and you're only, because maybe you came in, you're on a military reload, you're only going to be here 2 years or less, probably may not pay the extra points to buy it down. But isn't there sometimes a sweet spot on the mortgages? Sometimes, if you pay a half a point or, a point.
There's always a sweet spot because you're going to have that break-even point. And keep this in mind when a bank calculates what the interest rates are for the day, there's that sliding scale every day that changes as well. So one day it may only cost 1/4 of a point to buy it down 1/8 of a percent. And other days it may cost a whole percentage point to buy it down that much. So
that's really why, you want to talk to a mortgage pro, because this is, and I don't think sometimes when people do the mortgages online, I see the things like Rocket Mortgage and all that stuff, that they don't get that interaction with a person that can really explain fully all their options. Because it may make sense. Even I'm only on a 2-year TDY here, and I'm going to go ahead and and you may say, hey, you know what? If you pay $500 more, we're going to drop your payment. It's going to make your money.
It could.
Right.
It could, and it may not. So again, it really does come down to having that educated loan officer and that break-even point. And keep this in mind, statistically, every 7.5 years, somebody's either going to either move, upgrade, maybe refinance their mortgage, right? So it all really does come down to the individual's goals and what their plans are. If this is their forever home and, paying 3 points up front is going to lower their interest rate by, 0.3, 0.5%, and over the long haul could save them thousands of dollars by prepaying that interest up front. So it really does come down to the individual as far as whether or not it makes sense.
The more we're talking about it, I'm sure our listeners are starting to grasp that every family or every person's situation is different. And that's what it's a complicated process, but all the options, that's why you need somebody that's what they do. As a realtor, as a real estate broker, I always defer all my financing things to someone like Kingsley, who's a money expert, because that's their job. The realtors, we've got a great overall view of how the money works, but the ins and outs, the mortgage programs, what's available, what they can and can't do, what the credit score is that they need, that changes so much on a daily basis anymore that you have to have somebody that's their bread and butter. They live, eat, and breathe doing loans.
And here's how we handle it. I handle it at my branch. We have all of the same technology that all of the quote unquote missile people have, and I don't. It's kind of like a curse word in our company. But you can go online. You can do everything online. You can do everything on your phone if you wanted to, as far as technology is concerned. So you can apply right from your phone. You can even upload documents right from your phone. You can even have your credit pulled right from your phone. There's a lot of technology out there right now. So don't get blinded by what seems flashy, because at the end of the day, what you want to do is have that consultation with somebody that can direct you based on your scenario as to what the best possible loan is going to be for you.
Kingsley, one of our callers wants to know, what documents are they required to have to get approved for a mortgage? And they want to know, damn it, why are there so many?
There definitely are a lot of documents, and unfortunately, there's even more that you have to sign. You can thank our attorneys for that in general. It used to be, when I first started in here, like maybe this thick, like a quarter of an inch thick as far as paperwork that you had to sign, and, here's my ID and here's my income. Now all of a sudden, there's a document that you have to sign off of that says that you signed off on another document. And then another one that acknowledges that you signed off on that document because you signed off on another document. So from a standpoint of getting approved, however, it's pretty standard across the board. Again, it all comes down to your ability to pay, right? We want to make sure you can afford the mortgage. So they're going to want to see, let's assume you're a W-2 employee for this particular scenario. They're going to want to see pay stubs, usually a month's worth. They're going to want to see the last 2 years. Remember, we check a 2-year history for your employment. So they're going to look at 2 years W-2s and tax returns, 30 days of pay stubs, and, of course, where the cash is coming from for your down payment and or maybe some reserves in the bank. Those are the main documents that you need to see if you qualify for a mortgage. Obviously, we're going to want to see your ID. Verification of who you are, whether or not you're a citizen or if we're doing a different type of loan.
I don't need ID to vote. Why do I need ID for a mortgage?
I'm surprised it hasn't gotten to that or asked for that. But no, you definitely need a mortgage because we're going to come after you if you don't pay at the end of the day. Now, it does get a little bit more complicated if you're self-employed. Then we have to get into tax returns. If the tax returns aren't something where you show enough income for qualification, but we know you're making the money, there's alternative programs, bank statement programs. As we discussed before, if you've got a lot of assets, but not really showing the cash flow, that can be tweaked in a way to show that you've got the income. So, again, every scenario is different, but the basics are really how much are you making, and do you have enough cash to purchase the home?
And I know right after the show, we have a list we're posting up there. Trust me, right after the show, and you'll be able to get it about everything that you typically need.
Yes.
So, what are some of the fees that make up typical closing costs?
Well, you're going to have obviously your lender fees, and those lender fees really should not be extravagant. And that's why I say, if you're looking at the difference between interest rate and APY, and there's a huge jump if you're comparing lenders, somewhere in there they have fees that probably aren't standard across the board. Most lenders are going to have an underwriting fee. Most lenders are going to have a processing fee. Aside from that, really, to the lender, the only other thing that you really should be charged is a credit report fee. And they may call them different things. I mean, it might not be processing. It might be doc preparation, but at the end of the day, your fees really shouldn't be any more than $1,000, $1,500 total. Then you get into, you've got a lot of other fees involved with the purchase of a home. For example, title insurance.
Maybe a home inspection.
Home inspection is optional, but I always recommend getting it, even if it's a brand new home. Your appraisal to make sure that it's protecting you and the mortgage company, that the house is actually worth what you signed a contract on. If you signed a contract for $500, but it really only appraises for $400, you just saved yourself $100,000 based on that. Then you've got title insurance. If you're buying a previous home or even one that's being built, the last thing you want to do is buy a home that has liens on it. So a title insurance not only clears off whatever liens may be there, but also ensures that if there's an old lien that may pop on, it ensures that you're not going to be hit with that particular lien.
All right, so let's pay some bills here, and then when we come back, we're going to have Mr. Staz on from EnviroQuest.
The Real Estate Radio Guys with John Rainville and Kingsley Harmer. We'll be right back. Veterans, active duty military, and reservists. brokersrealty.com thanks you for your service. And during February, if you list or buy a home with brokersrealty.com, we will reward you with a getaway for 2 at settlement. As in a cruise, trip to Vegas, or even a whole week at a tropical resort-type getaway. Text REWARD to 79564. That's REWARD to 79564. Or Google brokersrealty.com today.
Everyone wants to buy, sell, or invest in real estate. If only they knew the best way to do it. Hi, I'm John Rainville.
And I'm Kingsley Harmer.
And we're the Real Estate Radio Guys. We bring over 40 years' experience to talk about all things real estate.
Weekly, we'll discuss the latest trends, hot topics, along with tips and techniques that could save you thousands and eliminate headaches.
So tune in to the Real Estate Radio Guys, Saturdays at 8 a.m. here on WHYL 102.9. Real topics, real answers for real people.
Are you working with a mortgage company that offers pre-approvals or just pre-qualifications? Does your mortgage company reward police, firefighters, military, teachers, and nurses with better rates and fees? How would you like to apply and be updated on the status of your loan right from your phone? Introducing GSF Mortgage Corporation, where technology and relationships make the difference. Visit pagoloan.com to apply or call 717-200-4800 for more information. NMLS number 1018.
Everyone wants to buy, sell, or invest in real estate. If only they knew the best way to do it. Hi, I'm John Rainville.
And I'm Kingsley Harmer.
And we're the Real Estate Radio Guys. We bring over 40 years' experience to talk about all things real estate.
Weekly, we'll discuss the latest trends, hot topics, along with tips and techniques that could save you thousands and eliminate headaches.
So tune in to the Real Estate Radio Guys, Saturdays at 8 a.m. here on WHYL 102.9. Real topics, real answers for real people.
Buying or selling a home? For professional home inspection, call EnviroQuest of Harrisburg. Their certified home inspectors will conduct a thorough inspection and provide a detailed report with many pictures. They'll explain the findings. Do you have elevated radon levels in your house? Call EnviroQuest. They have fixed over 10,000 homes over the last 25 years. For a professional home inspection or radon mitigation, call EnviroQuest at 233-6144, 233-6144, or visit EnviroQuest online at evqharrisburg.com. That's evqharrisburg.com.
Back to the show, the Real Estate Radio Guys with John Rainville and Kingsley Harmer.
Good morning, John. How are you doing this morning, buddy?
John? Are you there, John?
So where's Mr. Well, Mr. Staz might have to call back in. I don't know.
Yeah.
But while we're waiting for him, we'll talk about. So Kingsley, one of our listeners wants to know, what are the typical closing costs?
Well, again, the closing costs, you've got your lender closing costs, your title insurance, your title closing costs, and then you're going to have, unfortunately, costs that are involved with, your government. They're going to take taxes, property taxes, school taxes. Then there's transfer taxes. Then there's a recording fee, where they have to record that you actually own the property with the local county. And from there, obviously, you want to make sure that your home is protected, right? So you're going to have homeowners insurance. And you typically have to pay for a year's worth of homeowners insurance up front. And then you get into what's called an escrow account as well. And part of your mortgage payment usually includes that escrow, which includes 1/12 of whatever your property taxes for the year are and homeowners insurance for the year. So between that, the title cost, the lender costs, that's pretty much what you have.
All right. Good morning, John. You're online now.
Good morning.
Good morning. I know we're going to talk about home inspections and what a buyer should look at that's on the report. So what can you tell our listeners?
Sure. From a home inspection standpoint, first thing you want to do is look for a home inspector that is with a reputable company and is a member of a national home inspection organization, which that's a requirement of the Pennsylvania home inspection law. Regarding the home inspection itself, what you want to look for is, first of all, we find sometimes one of the biggest things that happens is we get a person that they want a house that is just move-in ready and they don't want to do any work, and then we do the home inspection and we find a lot more things. So basically the house is mismatched with the buyer. So you want to make sure that, I guess that's part of the real estate agent, to match the house with the buyer as far as the amount of work that it needs or the condition that it's in.
So once they get a copy of your report, what are the areas that they should focus on?
Sure.
Looking at in the actual report.
The actual report is based, the sections would be like structural, plumbing, exterior, interior, roofing, electrical. So we look at all the basic systems of the home. And one of the biggest things that the job of the home inspector is to communicate the magnitude of something that we find. The home inspection law, the Pennsylvania home inspection law, dictates that a home inspection is the evaluation, a non-invasive visual examination of the home, where we're looking for what's called a material defect, and that's right in the home inspection law. And a material defect is something that can affect the value of the home or the safety of the occupants. So that would be like a major defect.
So I guess it sounds to me like they should they should focus on those major defects that you outline on the home inspection. Those should be things that have their attention, because these are things that could be major repairs or whatever that need to be done, correct?
Yeah, we tell buyers or our clients, as we're going through the inspection, we'll point out the minor things along the way, just to inform them. But the main purpose of the home inspection is for more major things.
Now,
so go ahead.
When you do your home inspection, you summarize the issues with the home, correct? I mean, it's not like they have to read through every single section to find these major issues. You'll actually summarize, okay, look, with every inspection, obviously, I go through hundreds of items, and I summarize hundreds of items on this report. Here are the top 6 items that you really should focus in on whether or not you feel comfortable with buying this, correct?
Correct, yeah. One of the major jobs of the home inspector is to look at the defects that are found and categorize them. And so the material defects are things that would go into the summary. So it might be something like, not necessarily expensive, but it could be a health and safety issue, such as, a smoke detector's missing. That would go in the summary, even though it's relatively inexpensive to correct that condition. So we're evaluating the scope of the defects that we find, and the material defects are things that could affect health and safety of the occupants or could be major expense. We'll go into the summary section.
So when you're walking through a house, and I'm assuming 99% of the buyers are actually going to walk through with you, you're going to point out to them to say, hey, look, you see this furnace down here? It's about shot. This is a pretty major expense. It may cost you, $5,000 to $10,000. Or this roof only has 2 years left. I mean, you're going to kind of go into a generic version of as far as how much time you think a roof has left, which could cost them $10,000. So when they're purchasing a home at this point in time, this is a very important report to get, because you have a certain amount of time from your report to renegotiate with the sellers.
Yeah, here in PA, you've got 5 days. So if someone has, if the buyer has any questions, they can always reach back out to you or one of your inspectors, John, on any of these, major items, correct?
Correct, yeah, and that's a real important part of a home inspector's job. For example, a roof, it could be near the end of its life chronologically, but is it actually leaking at the time, or is it worn out? Basically we try to determine, does it need to be replaced yesterday, or does it need to be replaced in a year or 2 years? and, look for signs of leakage. Is it a situation where, hey, it's functioning now, but in 2 years, I wouldn't be surprised if it needs to be replaced. So we try to hash out those things during the inspection. That's why it's real important.
Yeah, I mean,
to be there if they can be there.
I agree. I mean, the inspection is probably one of the most important parts of the process of purchasing a home, because this is one of the largest investments for a buyer. And if they're going to buy a home for $300,000 and then all of a sudden have $30,000 in repairs, that could make or break somebody. When somebody gets a report done and they have questions on it or need to come back to you, what's the best phone number to contact you on?
Sure, it's 717-233-6144.
And if somebody needs, obviously, an inspection done, whether it's a new home buyer, investor, they can call that number. They can get a hold of you online, correct? It's ebqharrisburg.com, I believe?
That's it.
And you are on Facebook as well, correct?
Yes, we are.
All right, John, you have a great weekend, buddy. We'll talk to you next week.
Hey, you as well, guys. Have a great weekend.
You too. Okay, so back to Mr. Kingsley. Got some more questions up here from some of our listeners. One of them wants to know, how does an escrow account work, and why do they have to have one?
Okay, well, technically you do not have to have an escrow account. But an escrow account is definitely an assistance for somebody buying a home, especially first-time home buyers. Again, really all it is taking part of your monthly or your yearly taxes and your yearly homeowner's insurance, breaking it up into 12 equal payments to make it budget-friendly, to say, I need to put $100 a month away to be able to pay that bill at the end of the year or when that bill comes due.
So, for savings account, just to make sure you have the money and the bank knows that you got the money.
Correct.
So, real quick, what's the difference between private mortgage insurance and mortgage insurance premium?
Well, I'm not really going to get into the difference, but I will say that mortgage insurance and or private mortgage insurance is really set up for protection of the mortgage company, unfortunately. Really what it does is it ensures that in the event that you don't make their payment, that mortgage insurance or that mortgage company is going to be covered in the event of a loss.
Another one of our listeners wants to know, what is debt-to-income ratio? Where does that come about? Because they hear about it all the time on the mortgages.
Well, again, debt-to-income ratio in general terms, and we've gone over it a little bit more specific earlier, is your ability to pay the mortgage and all of your debts. There's what's called a front end and a back end. A front end ratio is the percentage of your mortgage company as compared to your total income per month. And your back end ratio is one of the most important aspects, is the total amount of debt, including your car payments, credit cards, student loans, alimony, child support, and others, obviously. That total amount of debt divided by the amount of total income, qualifiable income per month. And that debt-to-income ratio, based on different programs, has limits to determine whether or not it's affordable for you.
How does the bank determine what someone's mortgage payment is? What all goes in that?
Well, again, you've got the loan amount, you've got the down payment amount, or the purchase price minus the down payment amount equals your loan amount. That loan amount can be what they call amortized over a certain number of years. The longer the amount of years, the lower that payment's going to be. And, of course, the interest rate itself is the amount of money or the amount of interest that you're paying for that money. So the lower the interest rate, the longer the term, typically the lower the payment for you. And, of course, as we said before, most mortgage payments are going to include an escrow account, which will be added on to that principal and interest. And then, of course, mortgage insurance, PMI, MIP, will be tacked on in circumstances where you don't put a certain amount down, your down payment.
So let's just to recap this. So someone's mortgage payment, most times, not all times, so it includes principal and interest, mm-hmm. the real estate taxes and insurance, mm-hmm. and sometimes even their homeowners like insurance, right, is included in that taxes and insurance
the escrow
figure. So that's a bill that they don't have to pay. It's already sort of budgeted in
Correct.
into that forced savings plan that we're calling an escrow account.
Correct. And mortgage insurance.
So if they sell the house, okay, do they get the money back from anything that would be extra in that escrow account when they sell it?
Yes. Because you've been paying for this escrow, right, to have it built up. So any amount of taxes that you pay or prepay for that matter, you would get back at the time of settlement. So, for example, if you settled, let's say just June 1st, midway through or at the end of the month, and you've already paid for that whole year's taxes, the buyer would technically reimburse you for the amount of taxes that are already paid that they're going to benefit from. And then, of course, if you have any money in that escrow account, the mortgage company would send that back to you as well.
Now, Kingsley, I know that the mortgage rates have been relatively flat really over the last year, but now we're starting to see them come up. And a lot of my customers, when I'm out there, when we're talking with them about buying a home, they always want to know, what the heck is this thing called a rate lock, and when should they lock their rate in?
Well, we've been kind of fortunate over the last couple of years where interest rates, they may have gone up an eighth, down an eighth, up an eighth, down an eighth, but really flat across the board, as you had mentioned. Now we're getting into a point where the market is so volatile, bond markets, everything else as far as interest rates. I think we're at the highest point in the last 3 years as far as rates. And basically what a lock is saying, look, no matter what happens tomorrow or 2 weeks from now, I'm locking my interest rate at, let's say, 4.25% today. So I don't care what happens to the rates. I want to make sure I know what my payment's going to be from this point on. Now, is there an off chance that the market could downturn, as volatile as it is, and go down to 4.125? Yeah, there's an off chance that can happen in this particular market. But what I'm going to advise, especially in this particular period of time, when you have the ability to lock the rate, lock it, because you want to protect what your payment is going to be.
Yeah, and another listener just called in. They want to know if, they went to settlement at closing and they were told that their mortgage had already been sold off. Should they be concerned? Or, is anything going to change? What's that mean?
Well, you know how a bank borrows money to lend money?
Yep.
Well, banks buy money from other banks all the time. So when somebody purchases your mortgage, let's say you close with ABC Mortgage, but it was immediately sold or even sells 2 or 3 months down the road to XYZ Mortgage Company, nothing is going to change on your loan terms whatsoever. The only thing that's ever going to change is who you write the check out to. Plain and simple.
All right, so I know probably a bunch of our listeners, I know we covered a whole lot of material and in a pretty short time today about loans. So if they have questions on mortgages today or over the weekend, or, maybe they're listening to one of their kids, they're advising them to get a house, what's the best number to reach you and so they can sit down or at least have a phone conversation with you?
You can pretty much go or call me at 717-200-4800. If you'd like a one-on-one, that you've got some questions, but you really can't call, maybe 8 to 4, 9 to 5 throughout the day, you can go on to kingsley.today and schedule a meeting with me. That's KINGSLEY.today and schedule a one-on-one consultation. You can always reach us, at Real Estate Radio Guys on Facebook or PA Go Loan on Facebook and instant message me. Technology is great. You can pretty much reach out to me in a number of different ways.
And if you're a veteran, active duty, or a reservist, reach out to me this week at 717-554-7430 because we have a special going on where we're offering, our getaway trips to active duty, military, past and present, reservists, when they buy or sell a home through brokersrealty.com.
Free vacation?
Potentially, yeah. They could either get a getaway, to Vegas. They could go on a cruise. Lots of good things.
How about the Super Bowl?
I don't think there's time.
Yeah, probably not.
I don't think there's time. So, till next week.
Real people?
Real answers?
Real computers.
All right.
Thanks so much for listening to this episode of the Real Estate Radio Guys with John Rainville and Kingsley Harmer. For more great content and to stay up to date, visit pagoloan.com, brokersrealty.com, and facebook.com/Real Estate Radio Guy. If you enjoyed the episode, please rate and review, and we'll catch you next time on the Real Estate Radio Guys.
The greatest classic hits play on Oldies 102.9 WHYL.